If the war drags on. Robert Kiyosaki's big warning. Leave stocks or get trapped. Why his trust in gold, silver, oil, and Bitcoin has grown. One of the world's busiest shipping routes, the Strait of Hormuz, is almost jammed. Oil tankers are stuck. Insurance has become expensive. The market is trembling at every headline. And in the middle of all this, a famous investor author warns the world. This war is not going to end quickly, and if you want to see the future, change direction now. This is where the fear begins. Because when war, oil, inflation, and the stock market all get tied into the same story, the damage does not stay at the border alone. It reaches your pocket, your portfolio, and your future plans. And the curiosity is this. What exactly has Robert Kiyosaki seen that he keeps talking again and again about gold, silver, oil, Bitcoin, and now Ethereum? Right now, the global backdrop truly is extraordinary. According to Reuters' the 31st of March 2026 report, the ongoing war linked to Iran has become the biggest geopolitical shock for the global oil market. The same report said that the Strait of Hormuz, through which nearly 20% of the world's oil and LNG flows pass, is under disruption pressure, and analysts sharply revised their 2026 Brent crude forecast in just 1 month. According to the Reuters poll, the average Brent forecast rose from around $63.85 per barrel in February to $82.85 per barrel. In some extreme scenarios, oil was even feared to go as high as $190. So this is not just war news, it is a warning of an energy shock. Its impact did not stop with oil traders. Reporting by AP and Reuters showed that pressure increased on Asia's energy importing countries, supply chains got disrupted, refined fuel markets became tighter, and inflation fears strengthened again. In Europe, March inflation moved higher because of energy, while in countries like India, market analysts spoke about rupee weakness, imported inflation, and growth risks. Bernstein even warned that in a prolonged conflict scenario, the rupee could fall below 98 per dollar, and if the conflict stretched through all of 2026, the situation could become worse. This is the environment in which Robert Kiyosaki's social media post went viral. In a post on his verified X account on the 27th of March 2026, he wrote that if you want to become a rich investor, you have to look toward the future, and right now doing that is easy for 2 reasons. First, national debt will keep rising because governments will keep printing fake money, which will increase inflation. Second, in his words, the current war linked to Iran will never end, and that means oil prices will keep rising, which will push inflation even higher. In the same thread, he called US bonds the biggest lie and wrote that in his view, real gold, real silver, oil, food, Bitcoin, and Ethereum are the safest investments for 2026. Now, the first thing to understand here is this. Kiyosaki is not an economist, not a policymaker, and not a central bank official either. He is a best-selling finance author whose book Rich Dad Poor Dad had a huge cultural impact in the world of personal finance. But it is equally important that he often makes bold predictions. Sometimes about dollar collapse, sometimes bond crisis, sometimes stock crashes, sometimes silver booms. So taking every word of his like prophecy would not be wise. But the reason for his popularity is that he captures the fear people carry inside, the kind mainstream finance often acknowledges late. Debt, inflation, currency debasement, and blind faith in paper assets. Kiyosaki's core argument is not new. For years, he has been saying that if something can be easily printed, like fiat money, then eventually pressure will come on its value. According to his thinking, people treat cash, bonds, and traditional diversified portfolios as safety, but the real risk is hidden right there, because inflation quietly eats away purchasing power. This time his point got extra traction because global debt, Middle East war, and oil shock all became headlines together. In his post, he almost called the traditional advice: go to school, get a job, pay taxes, save money, invest in stocks, bonds, mutual funds obsolete. That line is provocative, but it is exactly this provocation that makes his post go viral. But is there some weight in his argument? Partly, yes. The national debt issue is real. Serious concerns over the US debt trajectory are not new. High debt does not mean collapse will happen tomorrow morning, but it does mean that if governments keep running deficits, central banks remain accommodative for a long time, and geopolitical shocks raise supply-side inflation, then pressure on cash holders and fixed-income savers can rise. Kiyosaki packages this macro anxiety in simple language by calling it fake money. His style is not academic, it is dramatic. But behind the drama, the theme, debt plus money creation plus inflation, is in fact a major debate in global finance. His second point, war won't end soon, also did not turn out to be just rhetoric. Reporting by Reuters, AP, and other outlets showed that the Iran conflict has already destabilized oil logistics, LNG flows, Asian supplies, and energy pricing. According to one AP report, traffic through Hormuz fell sharply, and Iran built de facto pressure over passage control. Reuters wrote that, in a prolonged closure scenario, there could be a supply disruption risk of as much as 13 to 14 million barrels per day. When that kind of risk starts getting priced into the market, oil stops being just a commodity and becomes a global inflation switch. That is why people are not taking Kiyosaki's war commentary lightly. Now let us understand why he used such an aggressive tone against stocks. Kiyosaki's problem is not with stocks themselves, but with blind stock investing. He argues that people blindly treat diversified portfolios as safety without really understanding them. His logic is that if the broader economy is debt-driven, valuations are stretched, war is increasing supply shock, oil is fueling inflation, and the currency is weakening, then traditional equity allocations can also come under pressure. At this moment, US and global markets have shown sharp swings on geopolitical headlines. Coverage by New York Post and Reuters showed that investor sentiment was reacting heavily to Trump's war-related statements and Hormuz news. That means the environment for stocks genuinely is jittery. But leave stocks should not be understood literally. Because if you look at history, productive businesses create wealth over the long term. The problem comes when an investor is sitting in the market with short-term panic, leverage, poor asset selection, and wrong timing. What Kiyosaki is essentially saying is, do not place blind trust in paper claims. Keep exposure to real assets. This advice comes in an extreme tone, but its softer version also exists in traditional portfolio construction, that is inflation hedges, commodity exposure, precious metals allocation, and diversification across different regimes. The only difference is that mainstream advisors may view this as a 5 to 15% allocation, while Kiyosaki presents it almost like an ideological mission. Now let us talk about gold and silver. In times of crisis, the discussion around these two metals is nothing new. For centuries, gold has been seen as a monetary hedge and a store of value. Silver's character is a little different. It is both a precious metal and an industrial metal. Kiyosaki especially has often remained bullish on silver. A February 2026 Mint report cited an earlier post of his in which he talked about silver reaching $200 or above and called dollar savers losers. That prediction is very aggressive, but it does show that he sees silver not just as a hedge, but as a high upside contrarian bet. The argument in favor of gold is relatively straightforward. If war drags on, oil stays high, inflation remains sticky, confidence in currencies comes under question, and sovereign debt concerns rise, then gold tends to attract psychological safe haven demand. The combined signal from Reuters oil reports and IMF-linked warnings is that prolonged Middle East instability can create a mix of higher prices and slower growth. In that kind of world, gold behaves like a fear asset. But it is also worth remembering that gold does not move upward in a straight line all the time. It also sees sharp corrections. So it is more realistic to view gold as an emergency hedge, not as a guaranteed quick profit machine. Silver is even more nuanced. If the economy slips into slowdown, industrial demand can be hurt. But if inflation fear becomes dominant and investors run toward hard assets, silver can catch speculative momentum very quickly. This dual nature is what makes silver exciting, but also risky. Kiyosaki's love for silver comes from exactly this volatility-friendly mindset. He does not speak like a conservative wealth protector, but like a high-conviction anti-fiat advocate. So for the listener hearing his script, it is very important to understand that silver is safe and silver is stable are not the same thing. Calling oil one of the safest investments sounds odd at first glance, because the common investor cannot buy physical oil directly. But Kiyosaki's point is broader. Energy scarcity can power future inflation. If the oil shock drags on, then transport, manufacturing, fertilizers, logistics, aviation, and shipping, every sector will be affected. The Reuters poll and Barclays warning showed exactly this. Prolonged Hormuz disruption can create a global supply loss scenario. In that case, energy-related exposure, whether producers or related assets, can become inflation winners. Kiyosaki places oil in the real asset category from this angle. Now crypto. And here Kiyosaki's position becomes even more interesting. Earlier he mainly spoke about Bitcoin, but this time he also named Ethereum. That shows his definition of real asset is not strictly physical. For him, real means something that a central authority cannot arbitrarily print or dilute. March 2026 reports from Business Today and Times of India, summarizing his portfolio preference, wrote that he considers real estate, oil, food, gold, silver, Bitcoin, and Ethereum safer than traditional financial assets. Crypto believers will love this view, but caution is necessary here. Crypto volatility is much higher than that of any bond or blue chip stock. So when Kiyosaki uses the word safe, he means it more in the sense of a psychological hedge, not in the conventional sense of risk-adjusted safety. And this is where a major contradiction also appears. While talking about inflation, dollar weakness, and bond risk, Kiyosaki recommends hard assets. But Bitcoin and Ethereum themselves are also crash-prone assets. So his framework is very different from traditional portfolio theory. He is willing to accept volatility if the long-term thesis is against fiat debasement. His thinking is tolerate the temporary boom-bust, but hold things that the Fed, the Treasury, or governments cannot print. That argument is ideological as much as it is financial. And perhaps that is exactly why his followers see him as a financial rebel, not a mainstream advisor. But should one really leave stocks altogether? The most balanced answer here would be, no, not completely. If an investor sees Kiyosaki's post and immediately exits equities entirely to move everything into gold, silver, and crypto, he may simply move from one risk into another, perhaps even bigger one. The right lesson is not stocks are finished, but that the macro regime is changing, so check your portfolio's vulnerability. Do you have an inflation hedge? Is your emergency fund in place? In a scenario of oil shock, currency weakness, and market volatility, will you avoid panic selling? Is your asset allocation still based only on old bull market habits? These are the real questions. For an investor in a country like India, this discussion becomes even more practical. If oil remains high for a long time, imported inflation, rupee pressure, current account concerns, and market volatility can all rise. Recent reports from Reuters and AP have already shown that Asia is taking the direct hit of the energy shock. For India, that can mean fuel costs, transport costs, imported commodities, and eventually broader inflation pressure. In such a situation, gold allocation, cash discipline, emergency funds, SIP continuity, and quality asset selection become even more important for Indian investors too. Kiyosaki's name may come from an American context, but the impact of an oil shock is global. One more important thing. While giving advice, Kiyosaki almost always says, "Don't take my word for it." This time too, he wrote that you should not trust his words blindly. You have to decide for yourself what real value means for you. That line is very important, because many financial posts that go viral on social media are so full of confidence that people forget due diligence. At least Kiyosaki admits that his view is an opinion, not a universal prescription. So for a mature investor, the right approach would be to take his warning as a trigger, to start research, not to make a panic decision. If the entire episode is summarized, the picture looks like this. The Middle East conflict has genuinely shaken the oil market, shipping lanes, inflation outlook, and investor sentiment. Kiyosaki connected this crisis to the debt, dollar, and asset allocation debate, and said that the traditional paper investing model is no longer as safe as people think. He called real gold, silver, oil, food, Bitcoin, and Ethereum his preferred assets. His tone is dramatic, his predictions are bold, and not everything he says has to be universally right. But his message certainly offers one useful warning. Do not buy mental peace just with salary, a savings account, and the phrase diversified portfolio. Understand the direction in which the world is changing. And perhaps that is the biggest twist in this whole story. If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.